Congratulations! You are now the proud owner of one of the absolute biggest, most brutally complex businesses in the world. Seriously, the keys are in your hands right now, and every single decision you make from this moment forward, it's going to determine whether this business explodes into a highly profitable local empire or, well, completely collapses overnight. So let's dive right into this explainer and see what you're made of.
Right, so picture this. It's 6 a.m., your very first day. You step up, unlock the front doors, the fluorescent lights flicker on, and boom, you're instantly staring down 30,000 distinct products. Within minutes, hundreds of people are going to start swarming through those doors every single hour, literally pulling money out of their pockets to hand to you. So I gotta ask, what is your very first move to keep this massive machine running?
It's a pretty intoxicating thought, isn't it? Because the sheer volume we're talking about here is just staggering. A large supermarket routinely pulls in between $500,000 and a cool $1 million in weekly sales. And that is every single week, 52 weeks a year. Just think about the resilience of that. Recessions, they don't stop people from buying bread. A global pandemic doesn't stop people from needing milk. The cash flow is massive, and it is absolutely relentless. Okay, but hold on a second. Before you go out and start shopping for a yacht, we need to look at the brutal reality of this industry. Take a look at this single, honestly terrifying number, 1.9%. That is the industry average net profit margin. In fact, giants like Kroger, they often operate closer to 1.5%. You are stepping into literally the highest volume, lowest margin, large business in the world. Every single penny is a total fight for survival.
Exactly. And honestly, to survive this, you're going to have to completely unlearn everything you think you know about how retail works. Look, the model most people know is super simple, right? You buy a can of soup for 60 cents from the supplier, you sell it to the customer for $1.50, and you pocket the 90 cents. But let me tell you, if you try to run your new empire on that assumption, you will be bankrupt by year 2, for sure. The real money actually comes from a totally hidden financial architecture that your customers never, ever see.
And that brings us to your absolute secret weapon. It's called slotting allowances. This is a total game changer. Consumer packaged goods companies, the massive brands making all your favorite sodas and snacks, they collectively spend between $70 and $80 billion a year in what's called trade spend. Think about that. They aren't just selling you products to put on your shelves, they're actually paying you for the privilege of placing their products favorably on those shelves.
Right, so the crucial plot twist here is this. As the owner, you aren't really just a traditional grocer, not at all. You are basically running a highly lucrative real estate and media platform. You are charging big brands distribution fees just for moving their product through your supply chain. And when a brand wants to run a promotional markdown, they pay you to fund the difference. So the real money isn't just in the markup on a box of cereal. It's in charging the manufacturer for access to the thousands of loyal shoppers you've brought into your building.
And that brilliantly illustrates another massive pillar of your profit strategy. Think about the fresh vegetables, the produce, the meats, the hot prepared foods, along with your store-owned private labels. These are your high-margin heroes. You aggressively use these higher-margin products to cross-subsidize those razor-thin margins you're making on the branded staples. You build real customer loyalty with fresh food and private labels they literally can't get anywhere else. And that right there is how you actually balance the books.
But hey, let's hit rewind for a quick second, because before you even open those doors for the first time, you actually have to build the place. And the upfront capital required? It's kind of terrifying. Whether you are building from the ground up or retrofitting an existing retail space, getting a grocery store ready requires a massive upfront investment. We're talking sometimes totaling anywhere between $5.4 million and $6.2 million before you make a single cent.
Yeah, and that immense price tag brings us to your hidden expenses. A massive chunk of that upfront cost comes down to tenant improvements, or what the industry calls TIs. Customizing a retail space for heavy grocery use, adding all the specialized plumbing, massive electrical panels, heavy-duty flooring, that often runs between $200 and $300 per square foot. This immense upfront debt puts just unbearable pressure on your store to achieve high-volume sales on day one. Seriously, there is no grace period here.
And once you are actually open, the daily operational grind just completely takes over. Let's break this down. Inventory alone is going to eat up about 70% of your revenue. Personnel takes another 20%. Rent is usually around 5%. That leaves just 5% left over for marketing, utilities, insurance, and hopefully a tiny bit of profit. When 90% of your cash is just permanently tied up in goods and labor, you have absolutely zero room for error. You need consistent, massive inventory churn just to keep the lights on.
And managing that inventory churn, it is a total logistical nightmare. A traditional supermarket carries anywhere from 20,000 to 60,000 individual stock-keeping units, or SKUs. And every single one of those unique product variants has to be ordered, received, unpacked, sorted, transported, unloaded, and shelved continuously. It's a crazy balancing act. If you order too little, the shelves are empty and your customers just leave. But if you order too much, the product expires before it's sold and you lose money.
Which leads us directly into the silent killer of grocery empires, shrinkage. This is the loss of inventory due to theft, administrative errors, or just plain spoiled goods. Let me put this as bluntly as possible. If a customer accidentally drops a jar of mayonnaise in aisle 4, you, the owner, you eat that cost. It gets expensed as a complete loss. And remember, in a business running on a 1.9% margin, a single bad quarter of unexpected shrinkage can literally wipe out your entire store's profit for the year.
To survive that kind of pressure, you're going to have to manage your people with absolute precision, because labor is your second largest expense. It's wild to see how different store formats try to control this variable. A conventional supermarket spends about 4.1% of its sales on labor, while the warehouse-style store strips that all the way down to just 1.8%. Honestly, the labor model you end up choosing is the variable most likely to determine if your location actually makes any real money.
So, as the new owner, let me challenge you with a very real crisis scenario. What happens to your empire tomorrow if the local minimum wage suddenly goes up? You might have hundreds of checkout workers and stockers on payroll. An increase in that wage floor causes an immediate, direct spike in your costs. But here's the trap. You can't just easily raise the price of your milk and bread to cover it, because your competitors down the street will instantly undercut you. Suddenly, that tiny 1.9% margin is under severe threat.
To survive this, your daily grind has to become an exercise in just ruthless efficiency. You've got to use incredibly precise scheduling, forecasting your foot traffic down to the hour. You have to cross-train your workers so they can jump from stocking shelves to running cash registers based on sudden demand. You're constantly balancing full-time stability with part-time flexibility. And perhaps most dauntingly, you are managing 2 a.m. fixed operational costs. Sure, weekend afternoons are insanely busy, but those massive refrigeration units, they cost the exact same to run at 2 a.m. on a dead Wednesday morning as they do at noon on a packed Saturday.
And this is exactly where the scale of your operation truly matters. Massive chain supermarkets survive because they can use sheer volume across hundreds of stores to basically brute force their way through those razor-thin margins. But what if you're operating an independent store in a rural town? Or maybe a municipally supported store in an underserved urban neighborhood? Our research shows these smaller footprint stores actually require much higher operating margins, around 3 to 5%, just to be sustainable. Why? Because they simply don't move the same massive volume as the mega chains. Sometimes, they even require public subsidies or specialized funding sources, like new market tax credits, just to keep their heads above water.
So the big question is, how do you protect this new empire of yours? Well, you have to aggressively innovate. You've got to quickly adopt new point-of-sale technology to maximize labor efficiency and get the latest security tech to fight off that shrinkage we talked about. You have to deeply understand your local community's habits and fiercely build their loyalty, maybe leaning into the shop local movement by offering locally sourced goods. And above all else, you absolutely must ruthlessly manage your inventory churn.
Okay, we've walked you through the hidden fees, the massive upfront costs, the complete logistical nightmares, and those notoriously razor-thin margins that define this incredible high-volume money machine. You've finally seen how this industry actually works behind the curtain, so I want to leave you with one final thought-provoking challenge. With the keys sitting right there in your hand, if you owned this business starting tomorrow morning, what would be the very first decision you make, and why?